we've ever seen. And then you look at the announcements that come out of the European Central Bank where they said this type of action, the demand for gold on the markets, is actually a threat to the entire system. They're acknowledging it. They acknowledge the fact that physical gold and silver demand is a threat to the system. Well, that's because for the first time ever, people are standing for delivery. This is coming right out of the European Central Bank. And so, yeah, I would say that we're getting closer to that moment than ever. And the value you find, the asymmetrical value, low downside, high upside, in silver rivals anything I've ever seen in finance in almost 4 decades.
After more than 3 decades navigating the precious metals market, Andy Schectman, president of Miles Franklin, believes the industry stands at a critical juncture. His assessment carries particular weight given his extensive experience witnessing multiple market cycles, economic upheavals, and precious metals booms and busts. Today, Schectman sees silver presenting what he describes as one of the most compelling asymmetrical investment opportunities in all of finance. A setup where downside risks appear contained, while upside potential could prove massive. The metal's characteristic volatility, often viewed as a drawback, actually reinforces its potential for substantial gains. The dramatic price movement between 2022's lows and 2024's peaks demonstrates how quickly momentum can build in precious metals markets. This historical precedent suggests that silver may hold significant upside potential, extending through 2025 and into 2026, particularly as supply constraints tighten and industrial demand continues expanding across emerging technologies. What makes Schectman's current outlook particularly noteworthy is his interpretation of recent developments in institutional precious metals markets. He points to acknowledgments from the European Central Bank that rising gold demand now poses a threat to financial system stability. In Schectman's view, this represents a watershed moment, the first time major financial institutions have openly recognized that physical precious metals demand constitutes a systemic risk to existing monetary structures. The European Central Bank's concerns center on structural vulnerabilities within gold markets, including heavy dependence on a limited number of major participants and insufficient transparency across trading networks. These weaknesses create conditions where supply shortages could trigger cascading losses for financial institutions during periods of market stress. The intensifying pressure from central bank purchases and growing investor demand for physical delivery is exacerbating these systemic risks. Before we begin, don't forget to like, share, and subscribe. 97.4% of viewers haven't subscribed. Be part of the 2.6% who have by clicking that button and hitting the bell icon so you never miss an update.
Ratio of 92, once it gets to 45 to 1 or whatnot, you switch back. Well, 45 to 1 would represent roughly the 200-year average of the price, last 200 years. That's roughly the average of the price or the ratio between gold and silver. And then at the same time, it's still coming out of the ground 6 times lower than that. So when you talk about a generational value, it is. And has been for a while. That it exemplifies the statement that the markets can stay irrational longer than we can stay solvent. But yeah, it is the trade that I think people should think of, and it's very easy to do. And we can help people do it. We lock both sides of the order in. We send you the invoices. We send you FedEx air bills. You ship back your gold. We sell that gold to the marketplace, and we turn around and ship you your silver with the proceeds that you never wrote out a check for. It's that easy, and in some respects, I think it's a no-brainer, especially when you look at things like pre-65 constitutional silver, which we can do at prices that I've never seen on this stuff before. So there are really good values to be found in the silver market, even with silver eagles. But whatever you're buying, the premiums are as low as I've ever seen them. The availability is quite good, and the reason to do it is very, very sound. I guess we just have to wonder how long before we see that ratio revert or correct, and I just think that there are very few opportunities that you will ever get like this in investing. I really do mean that. There are very few times where in order to double what you started with, you just need to reach the average of the past 200 years. So that's not a lot, and I think it's the way to look at it. Really, instead of the silver to gold ratio, is look at it as the price of silver measured in gold. And they've mostly ranged between 1/50th and 1/80th of an ounce, but have averaged roughly 1/45th. But when you get anywhere near the extreme low of about a 1/100th of an ounce of gold, What that really means is that silver is one of the cheapest levels it's ever been in all of recorded human history. And it's a rare setup with unbelievably strong upside potential. Opportunities like this don't come around often, I guess is all I'm trying to say. And that's the truth. That's not salesmanship. That's just historical fact. And it's one that I would think is an opportunity that people should strongly consider, especially in an IRA, because then you have no tax implications. You don't have to mail anything back. It's just bing and boom. And then you can switch back to gold when the ratio corrects and double what you otherwise, double what you started with here today, which is something that I think you could very easily see. And you look at gold, and it just seems to me that gold has broken free from this and seems like it's being controlled more by the Chinese and other markets than it is by the COMEX. So only time will tell. But silver is still within the grips of the bankers, and although a very dangerous game, I would say, that they are playing. And the next couple of days, I think, is exactly why. If it got away from them, you're talking blowing up some of the biggest banks in the world. Now, I doubt it will get away from them here yet, but we're getting to that point where the deliveries are very easily overwhelming the availability of what is on the exchanges or what can quickly be delivered. Look at the LBMA. Sorry, guys, you're supposed to get your bars in 3 days. We're 8 weeks because we have a shortage of trucks and manpower. That's not true. It's that they've got caught and they're scrambling, trying to get those bars to be able to make those deliveries. It's as close to a default as we've ever seen. And then you look at the announcements that come out of the European Central Bank, where they said this type of action, the demand for gold on the markets, is actually a threat to the entire system. They acknowledge the fact that physical gold and silver demand is a threat to the system. Well, that's because for the first time ever, people are standing for delivery. This is coming right out of the European Central Bank. And so, yeah, I would say that we're getting closer to that moment than ever, and the value you find, the asymmetrical value, low downside, high upside, in silver rivals anything I've ever seen in finance in almost 4 decades.
Andy Schectman has identified a decisive trend in commodities markets. Sophisticated investors are abandoning cash settlements in favor of physical delivery. This shift has produced the largest COMEX delivery volumes ever recorded for both gold and silver during the May contract period, signaling a fundamental change in how major market participants approach precious metals investments. The surge in physical delivery demands goes beyond statistical curiosity. It reveals that informed investors now actively prefer metal ownership over paper positions. This preference suggests mounting concerns about counterparty risk or expectations that paper and physical markets will diverge significantly. Gold deliveries have hit unprecedented levels since the November election, despite reduced arbitrage opportunities. This timing is particularly significant because May typically represents a minor delivery month for gold contracts. The exceptional activity during this traditionally quiet period indicates that physical gold demand has intensified beyond normal market cycles, with investors prioritizing ownership despite diminished profit margins from conventional trading strategies. Silver deliveries achieved the second largest volume since 2021, marking May as a major contract month with substantial market implications. The surge parallels gold's trend, but carries greater significance, given silver's major contract status typically ensures higher delivery volumes. Let's get back to the interview.
Well, I think right now the real value is found in silver and in platinum, and that's where there has been more demand recently than there has in gold, simply because, gold has moved up so fast and silver and platinum had lagged behind from a standpoint of, historical standpoint. Both in relation to gold represent an unbelievable value. So we've seen a lot of purchases of platinum. We've seen a lot of purchases of silver. So yeah, I think that in general, the public, Jay, is out of, not really part of this rally. The rally has been by sophisticated investors, central banks, and commercial banks and sovereign wealth funds that have been pushing the price higher. And even in that environment where you're seeing, it's interesting because you're seeing the institutional investors sell every single week since February equities and dumping at a level at the last 4 weeks have averaged $2 billion per week. The insiders selling equities. At the same time, mom and pop retail investors have a larger allocation to equities than ever before, even greater than the dot-com bubble at like 53%. So what could possibly go wrong there? And then at the same time, you have it inverted on commodities. You have the biggest money in the world, those that are the most sophisticated, standing for delivery to the point where we're seeing the largest delivery in the history of the COMEX market in both gold and silver on the May contract. And we'll see what those numbers look like here on Friday. But again, you got quarter end on Monday, you got options expiration, and you got these silver contracts going off the board. It's going to be an interesting few days. I would suspect there to be probably even a little bit more weakness heading into the end of the year. But the public is missing this. And that's been done maybe by design, certainly, through volatility, through rhetoric, through lack of anything positive to be reported on gold and silver. So for those that have been buying, we've been recommending to them to buy silver and to buy platinum because you don't get values like that very often. They're generational values when you compare them on a historical precedent to their relationship with gold, to their relationship historically. Yeah, there's been some gold buying, but mostly it's been silver, and then second would be platinum. Silver, on the other hand, across the board represents, in my opinion, value of a generation. When I think of silver, I think of the word asymmetrical, lowest downside, highest upside. But with all of this said, the only people that are taking advantage of that are the most sophisticated, well-informed traders in the world. And why I say sophisticated is because the amount of deliveries coming off of COMEX is record-breaking. It's groundbreaking. And it's not an easy thing to do. These are people that are very connected, they're very smart, and when they're pulling off as much metal off of the exchange as they've been doing, where are they moving it to, and who's taking possession of it? And these are things that I think people need to think about. Who's got the ability to stand for delivery to that degree in gold and silver, silver in particular? The public, I think, Jared, is missing this largely, but those that have been buying have been focusing on silver or platinum.
Gold and silver remain resilient amid continued price suppression efforts. Despite record short positions, both metals hold firm, supported by strong physical demand. Gold continues to serve as a cornerstone of monetary stability, while silver offers unmatched asymmetrical upside. Though gold led the initial rally, silver is steadily narrowing the gap. Their price movements remain closely aligned, with a one-year rolling correlation typically ranging from 0.68 to 0.95. Is silver the most overlooked opportunity in today's market? Let us know your thoughts in the comments below. If you found this video valuable, be sure to like, share, and subscribe for more updates on gold and silver. Don't miss out. Join the 2.6% who've already subscribed by hitting that button. We'll see you in the next video.